The broadcast is now starting. All attendees are in listen-only mode.
Okay, I think we're in order. Everything seems to be okay. All right, let's go ahead and get underway. Welcome everybody to the May 2019 edition of the Investing Roundtable. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the sponsors and producers of this monthly session that's been going on now for almost 9 years. In fact, near the end of July, we will have our 9th birthday celebration. I'm joined here tonight by our wonderful colleague and damsel, Kim Butcher, originally from Evansville, Indiana, but she's been spending a lot of time in Florida. Hope everything's okay down there, Kim.
Yep, we're doing good.
And also joined by my dear friend and colleague, Ken Kavula, just from a few miles to the north. He's doing well also. He's spending less time in the yard, but doing okay. How are you, Ken?
I'm doing just great, Mark. It was actually a pretty decent day here after the rough start we had this morning with all the rain, but got a lot of stuff accomplished and kind of eager to get this underway. So whenever you're ready.
Okay, well, here we go. The cover slide is obviously inspired by the Game of Thrones, and you can see that it's actually done to antagonize Ken, who when we started this many years ago, said, okay, we'll do it, but no costumes. So part of the response to that is to occasionally subject us to costumes and hats on the cover slide. But Sai's unable to join us tonight, and also Hugh, the two knights that are shown there, unable to join us tonight, and they both send their best regards and apologies. But again, Game of Thrones is one of the hottest things going on these days, no pun intended. A little bit of rain on Game of Thrones would probably be a good thing with all the dragons running around, but that series is now wrapped up, and we'll have to find something else for costumes next month. Let's get our legal paperwork out of the way. You guys are pretty familiar with the disclaimer based on the names I'm seeing on the attendance list here tonight. No investment recommendation whatsoever is intended. This is all about education. It's about demonstrating the principles and the analytical techniques of the modern investment club movement. And that's what we do here. That's why we're here. We're here to share ideas and to give some insight into the methods and the approach that we have to investing and building wealth using common stocks. We might own some of the stocks that we talk about. We generally try to disclose that, but just know that that could be the case. Again, no investment recommendation is intended. If you have a friend or a family member who you think would benefit from a reminder about these events, again, we hold them just once a month. We do have a couple extra educational sessions that we send out notices about. You can send an email to nkavula1@comcast.net, and Natalie will take care of you. She will not inundate you with emails. She'll just let you know when these events are coming up. If you want copies of the slides or if you have follow-up questions and answers after the session, you are welcome and encouraged to send it to me, Mark R. at manifestinvesting.com. And we'll do our best to address that. Here's our standing agenda. Again, we've been doing this for almost 9 years now. Again, welcome everybody. An extra big welcome if you're here for the first time. We do try to keep this fairly informal. We will open up the microphone. You can enter comments written style, and Ken will monitor the back room. Kim's back there too. So you've got that going for you. So again, welcome. We'll keep it informal. We do record this session and make copies available, archived versions on YouTube. You can go to Manifest Investing Roundtable, and you'll find several years worth of program. We keep track of how well we do. We'll discuss that here in a few minutes. And again, our discussions often center around long-term perspectives. We're not going to spend a lot of time on discussion tonight. We actually have a couple questions that we want to get to in the Q&A at the end. We have no challenges tonight, but we'll describe the type of challenges that we do. We are going to look a little bit at quality degradation tonight. Then we'll go into the 3 stock presentations. Kim will provide Air Lease. Ken is coming with Charles Schwab. and I'm going to present Regeneron Pharma. You see the three tickers there? We do an audience poll after the three presentations where you will be selecting from the three or none of the above. Please don't do that tonight, though, when we take the audience poll, because the selection made by the audience tonight will be the 500th decision or selection made by this over the last, again, almost 9 years. We will try to leave some time for a Q&A at the end. So here's just a reminder of what we're here to do. We're here to share. We're here to share and hopefully devastate the mysteries of investing. That's what we're about. We will be describing one of our single favorite actionable investment opportunities. When we say actionable, we mean action in terms of study it, do the due diligence and all the stuff that you need to do. We do welcome creative non-core selections, but we try not to let them dominate the portfolio. There are a few in there, but not too many. And we do want to beat the Wilshire 5000 by 5 percentage points over the long term. And like I said, we'll show you that in a second. We do like to see over half of our selections beat mirroring investments in the total stock market index. Here is our performance. It's a performance that we are thrilled with. Again, approaching 9 years. The rate of return is 16 or 17%. I think it's 16.4 right now. And if you had just invested those $496,000 investments into the Wilshire 5000, your rate of return would be 10.4%. That means that the relative return, which is simply what we have achieved minus what we would have achieved investing in that benchmark, is plus 6%. The long-term objective of most investment clubs is to beat the market by 5 percentage points. That's the red line across the middle there, and you can see that we were below it for a while, and we've managed to creep up above it. We hope to stay above it and perhaps even nudge a little bit higher if we continue to make solid investments or selections over the long term. Any questions or comments at this point, Ken or Kim?
No, everything's clear right now, Mark.
Okay, let's go ahead and keep pressing on. Here's the actual top 20 by the size of the positions in the portfolio. I think there's probably 80-ish or so total positions in the portfolio. What we do for every single position in the portfolio is invest $1,000 when it is selected or chosen, whether it be by a knight or a guest damsel like Kim or the audience. We will invest $1,000 into it. That legend up at the top actually gives you the number of repeat selections. So for example, Cognizant Technology has been selected 15 times. That means $15,000 has been invested, and it is now worth almost $22,000. So you can actually decode going all the way down the list. Amazon, for example, is a 2-time selection. $2,000 invested into Amazon is now worth $12,000. So those are the type of things that that's what we're here for with our own personal and club real investing efforts. So from top to bottom, you can see those are the top 20, again, by position size. And several household names there, but a few of the less so much household names creeping into it. The one that I love to see on there is Ulta Beauty, which we have been accumulating over almost the entire 9-year period. Ulta Beauty has been selected 7 times over the last 9 years, and that is the top performing stock in the S&P 500 over the last 10 years. Anything jump off the page, Ken or Kim?
Well, Mark, I just like to see the names that appear only with 1 or 2 choices. They're fascinating to me. LGIH, for example, only has three times picked into the portfolio, but it's worth over $6,500. So there's a double your money just since we started working with it. There's 3 or 4 on this top 20 list that have only been picked 2, 3, 4 times, and that is a really exciting thing to have happen. EPAM, one of Cy's real favorite picks, has only been picked 4 times. And EPAM is worth almost $8,000 right now. And we just started accumulating EPAM maybe 2.5 years ago. So there's a lot of opportunity out there. There always is. But remember, do your own homework, do your own SSG, and draw your own conclusions as to whether or not something is a buy in today's market at today's price.
Yeah, and I really like seeing that PayPal is there, who's only been picked 3 times, and that was the spinoff, and S&P Global was the spinoff. And that, is done well. And now I can see where you've got Global Payments on there, and Global Payments announced today that they put in an offer and they're going to be merging with Total System Services.
Mm-hmm. Yeah, that Global Payments, by the way, I think that's a one-time selection by Sybe back in 2010. So that just shows you what is possible.
Oh, yeah.
At most, maybe 2-time selection, but I don't see it up at the top. I'm pretty sure it's a one. It's a one-time.
Yeah, I'm auditing the list, and I don't see GPM on the list, which means it's a one-time pick. That's a really good one, isn't it?
That's why we keep him around. Hey, they told me I have to be nicer to him. Of course, that wasn't his handwriting, so we'll see. There's a lot of good stuff on there, but again, if you want to look at all the positions in the portfolio, you can reach them via that public link up at the top of the page. So let's go ahead and keep pressing on. One of the selling disciplines we've been trying to do, although it's a tracking portfolio, we are tinkering with notions of portfolio management, design and management discipline with the portfolio, and starting with, we always want to be watching for the opportunity to improve the overall return forecast of the portfolio. And what you see at the top of the chart, in fact, as we were just talking about Global Payments, one-time selection is almost $8,000. Well, because it has been such a strong price performer, the return forecast is actually the lowest of all the companies in the portfolio. As you can see on the far right, that column are the 5 lowest PARs or return forecasts in the portfolio right now. Now, none of those are dramatically low. We would consider an excellent quality company to be a candidate for sale when it gets down around money market rates. In today's world, down in that 1 to 2% range, or perhaps even less. So these are all pretty solid companies, and I don't think we should be in any hurry to go after them. Ken, would you like to reinforce just the overall perspective on the portfolio? And
yeah,
think about
the only exception to that rule might be Cerner, Mark, because it's in a position of being involved with M&A. So, Cerner might be something that we would sell out of the portfolio right now because there was an offer made for it. Its price went up, and I don't think the deal has closed yet. I might be wrong, but I don't think the deal has actually closed for Cerner. Usually around here, when clubs ask the question, what do I do when a stock's gone up because somebody's made a bid for it? Our advice is usually take the money and run because you always have the possibility of the deal falling through. Mark wants me to go over the report card real quickly, and I'm looking at my par at 9.3%. Remember that the 100-year plus average for the stock market, depending on how you measure it, has been somewhere around 9-10%. So that 9.3 is historically right about at the average of where we would expect a typical stock to give us a typical return. Nicholson asked us to try to aim 5 points above that typical number, so 14.3 is that 5, and he also counseled us not to be greedy. It's very difficult to achieve more than 10 points above where your average happens to be, so that's the top of the sweet spot is 10 points above my par at that 19.3. We'd love for our par, for our portfolio to be green and right in that sweet spot. But certainly 2.5 points above, 9.3 to 11.9 is a little bit better than 2.5 points above. That's awfully good for a 9-year-old portfolio with over 100, maybe 140 plus holdings in it. So if we can move that up, that'd be great. But at the same time, that's a really good par value. Mark and I talk a lot about how much just 1% above the market can do to improve your results. 2.5 points above the market can really boost you up, and it doesn't just double or multiply it by 2.5. It sometimes gives you exponential growth moving forward. Quality is superb. You hardly ever find a better investing portfolio where the people that put it together don't understand quality stocks. Our average, these are weighted averages, and our average of 87.8, that's a percentile number, and that's certainly exceptional. I don't see anything with we'd having to fool around with that number. Our growth might be just a touch light. I think that we've set ourselves about 11.5, maybe even 12% as a benchmark for growth. So again, if we have the opportunity to put in faster growing companies, by all means, I would suggest we do that. And you start to look sometimes at the stocks at the bottom of your par list, like you see at the top of this slide, and you'll notice many times that the stocks that are at the bottom of the par list tend to have growths that are beginning to slow a little bit as well. None of these are terrible growths, especially for the size of the company that they're dealing with, but we might be considering, except for Universal Display, we might be considering the fact that there are companies where you can get 10, 11, 12, 14 points of sales growth, and that's certainly what is going to help boost your par when you have faster growth in sales. We don't tend to worry too much about overall PE ratio unless it becomes extreme, and in my mind, extreme would be a lot higher than 23. Financial strength and earnings stability, if you can keep those at 75 or 80 or above, then you're doing your job. And for me, at least, yield is gravy. I tend to invest as if the portfolio is going to go on forever. And whatever comes in the way of yield, I put back into the portfolio. But I don't chase yield. I'm not a dividend investor. I'm not investing for cash that I'm going to spend immediately. So all my dividends go right back into the growth portfolio, buying more of these great growth stocks that we've identified.
Sounds good. Thanks, Ken. The second and third criteria or conditions where we think about evaluating a company for potential sale would be that number 2, that's the rule of 5 driven, stock that's just simply misbehaving, especially in that first year. We're going to perhaps talk about this a little bit more in the Q&A, and certainly in coming months as we continue to scratch our heads over that particular criteria. But we do believe in noticing when a company has failed to keep up with the market, lagging it by as much as 20%, and use this notion of a timeout, much as you might experience with children or grandchildren. We don't have any that fit that category tonight, so we'll be possibly have some to debate next month. The one that I will say, however, Mark, that you and I are going to do a better job at reminding each other that this idea originally grew out of trying to figure out what to do with stocks that we had recently purchased that were not behaving themselves. So when you say first year, maybe first 18 months, we need to reinforce that with each other. I don't think that our timeout idea extended as far as something that you might have held for 6 or 7 years, and maybe we got off track just a little bit on that particular idea in the last 6 months or so. Yeah, and I think we should talk about that more, perhaps in the Q&A tonight, but certainly perhaps even as a standalone topic. But yeah, it's. I think we've created a void that needs to be filled with something that's simple but powerful. So yeah. That sounds like something we can handle with a few highway miles at some point in the future.
Absolutely.
All right, so there are three companies I thought I would just flag tonight. I just looked down the list and looked for companies that the quality seemed to be dropping, perhaps out of the excellent, top 20% quintile down into the still good, but in the 60 to 80 percentile rankings. And I don't think any of these are a surprise. Qualcomm, LKQ's been under some fairly intense competitive pressure, and some of their recent acquisitions don't seem to be going quite as well, and you're seeing that in the quality. The financial strength is under some pressure. Anytime you have competitive pressures, you can have margin erosion. You can have price wars. all that type of thing can actually come to play in the quality rating. We know that Qualcomm has been seriously challenged, and they're kind of in a yo-yo mode of, I'm not sure what they're doing in court today, but they were given clearance a month ago, and then 2 weeks later it was back on, and it's still a mystery, but it seems to be sorting itself out. And the other one that kind of popped at me was PriceSmart has actually had a fairly good size drop down here in recent months, and quality degradation by itself can be enough to walk away from a position.
Well, Mark, I'm going to make a couple radical suggestions. First of all, I'm going to suggest that with the added back-in risk that Qualcomm seems to have back in the court system yet again, I'm going to suggest we take the money from the recent upswing in stock price in Qualcomm and call it a day on that chip stock. I've been the stock watcher for LKQ in one of my clubs, and I'm going to suggest that not only is there quality degradation going on in LKQ, but there's real strong fundamental problems with parts of the company, especially as it comes to margin and things like that. And I'm going to suggest that we unload that position or positions. And we did learn that we have as much as 5 or 6 months sometimes before the stock tends to follow the drop in quality. And the most dramatic drop in quality, I think, belongs to PriceSmart, and it looks like it happened 5, 6 months ago. Looks like the stock price has plateaued fairly evenly in the most recent 5 or 6 months, and I'm going to suggest that we take our 1 or 2 holdings and get rid of those as well. I'm not pleased with these quality graphs on any one of these 3, especially LKQ, and I think Qualcomm is a story unto itself right now.
Well, I guess I would second that motion too. We're going to possibly talk about Skyworks Solutions and have some of the same type of contemplation about that one after we're done here. Yeah, I'm all for it. Let's go ahead and experiment away with those.
Okay.
All right. So with that, I've changed the batting order from the presentations done in Chicago because the rumor, you may have heard the ugly rumors that we only gave Kim like 2 minutes to do a 12-minute presentation, and she did a fantastic job. Actually, the audience voted for her stock, even though it was abbreviated, and we caught all kinds of chauvinistic criticism about not letting the lady talk. And tonight we're gonna, I'm just reading the cards, Ken. Tonight we're gonna go ahead, Kim. The floor is yours. You use it as you see fit, and tell the story.
Okay, well, I'm going to tell the story, and I kind of just talk straight to the point, so this might be a quick presentation still.
Okay.
Okay.
Right.
I'm presenting Air Lease again. I presented it in December, and as those planes are going there, let's see if it can keep on flying up. You can see by the lines there that obviously they've had really good, if you had all 3 lines up, straight, and parallel. In the last quarter, they had revenues up 22% and diluted earnings per share was up 23%. Their margins and the return on equity are nice and solid. Next slide. These are the times that Air Lease has been chosen. I presented this stock in December at $29.73. It closed last Friday at $36.76. So if you had bought the stock in December after the presentation on Manifest Roundtable, you'd be up 23.6%. And so does this stock still have any more room to fly high? So let's find out. Since the December presentation, there was a crash of another 737 plane, and the FAA has grounded all of the 737 planes. So let's look at, next slide, what's new and what's going on. Air Lease has only 5.4% of the current fleet, or only 15 planes out of all the planes that they lease out to be 737s. But they are slated to have another 28 arrive this year. Now, if the 737 MAX flies this summer, it may not have an impact on earnings depending on when the FAA would release this. Now, at convention, I gave this presentation on Saturday, which I believe was the 19th of May, and here we are at the 28th. They have announced that Boeing has completed its update on the software, and they're working with the FAA to get the planes back in the air. And many of you know me about my lectures about checklists, and they are currently developing checklists to get this plane back in the air. And a big red asterisk is, as I'm sitting in the recliner doing my presentation, I see the TV for a minute there flashed and said, CNBC will be having Boeing on tomorrow talking about the 737s. So next slide.
Kim, I'm going to step in. That's actually an exclusive interview being done by the incoming anchor for CBS, and her name has escaped me, but it's a CBS interview with the CEO of Boeing.
So if any of you want to do more research, you can watch TV tomorrow and see it. So as I said, that in the first quarter, great results, revenue's up, earnings per share is up, but the biggest thing I really struck me smack in the face when I was looking at this stock was the book value was $46.56, and the stock was oh so low. And whenever it's very rare that you can find a stock that is less than book, and I have to admit that this is the stock that is in my investment club called Bionic that I'm supposed to follow. So I will let you know that I have it in our club, that we have it. Well, the stock closed today at $36.73. So look about the difference. That's at least $10 difference practically between the current price and the book value price. And with that's going on, to get to that 36 to 46, you're talking like that's another 25%. It can keep on flying and going up. Next slide. As a review, this is a play on how our population is increasing and we're getting a larger middle class. And this is from the Air Lease presentation from the first quarter, that they believe, and they've had the statistics that passenger traffic is up 4.8%. They've got more loads because they sell certain portions of their fleet also for cargo shipping. The profit that the airlines have been having is like $35.5 billion going forward. Next slide. So Air Lease is continuing to benefit from those three key tailwinds of higher levels of passenger traffic, and those airlines need to replace the aging aircraft, and those airlines want to have the fastest, most fuel efficient planes. So leasers are increasing overall. As there's a slide that how the role of leasers have increased for Air Lease, and it has exponentially just grown. Next slide. And we all like to have a stock within our portfolio that has international growth. It's just not domestic. And as you can see here, the global growth is across everywhere. Africa, Asia Pacific, Middle East, Latin America, a little bit of everywhere. So across the whole globe, it's 3.5%, and the total market of passenger traffic up 6.5%. Now, the next slide. This is really interesting. When I was looking at this, and Mark pointed it out to me, I've always thought that book value was very important, and Mark was playing with the graph, and he just put the stock price and he put book value on there. Now, in the green circle is the stock price. But if you can see as to where the book value is, the average price to book value has been 1.7, so about equal. So if it's going to get back to book, which seems reasonable by how it has shown that it can do that and it reverts back to that mean of book value, look how much higher it can go. Next slide. Now, I looked on Yahoo and found out what the book value was. Morningstar has the price to fair value at $46.22, which is another 25.7% increase compared to the current price. And you can see at the top of the graph where it has Air Lease by the manifest dashboard of quality of 98. You can't get much better than that, and a par of 19.7. I think I would call that a cha-ching moment. So I hope you will all consider, because I did my SSG, and the average PE on Air Lease is like 10.7. Currently it's like 8, but because of what's going on in the market, I feel there's PE compression going on. And I have a high PE of 8. So if you can just get the PE equal to what the current PE is at, that gives it a 3.2 to 1. And ultimately, it could go up to over $80. So with a little dividend, I hope you guys will consider tonight Air Lease as a stock for your portfolio and have another ka-ching moment.
All right. Well, thanks, Kim. Yeah, a lot of the indications are pretty good, and as you mentioned, it's definitely a discovered favorite stock in the community. In fact, it's by far the most commonly selected stock in this year's Groundhog Challenge that we hold at Manifest, where people are out there trying to pick stocks, and it was the #1 stock chosen. So let's hope.
Mark, our audience has chimed in. That will be an interview during the CBS Evening News tomorrow night, and it'll be conducted by Nora O'Donnell, who's the incoming anchor for that program. I have a hand in the air also with a question from Ethel. Ethel, I'm going to unmute you, and you can go ahead and speak. Ethel, you appear to be muted on your side, so you need to unmute from your end. Okay, I'm not getting any action, so I'm going to take the hand down and continue with what we're doing here.
Okay. So we're going to go ahead, and I will tell you that, you know, this slide really got me, because I felt like I was at an extremely formal wedding. I see this and I feel like I want to put on a tux. Looks just like a.
What I did, Mark, was I took the cover slide from the Charles Schwab.
That doesn't help me know why I'm not getting my mail.
Do you want to listen to them?
Yeah, I mean, I'm listening to it. I just can't see any slides.
Okay,
I'm
hearing. That must be Ethel, right? So let me see if she found a way to unmute yourself. Ethel, can you hear me? Okay.
Yes.
Okay. Was your hand up in the air?
No, it was an accident. I'm sorry.
Okay, I'm gonna put you back on mute, and we'll continue now. Mark, this was from the cover slide of the Charles Schwab corporate presentation, and in the middle they were just they had investors, so I just changed it to my name and the Bank National Convention Roundtable. And if you'll do the next slide, it was just a nice opening slide, I thought. I'm not going to do too many slides from this presentation. It was about 65 or 70 slides, but I picked out a couple of my most favorite slides. One of them is this one right here that shows Schwab growing its client accounts at an annualized rate of a total rate of 77% versus 2008. So in the last 10 years, they've grown their total number of accounts by more than 3/4. and the amount of trading that's been going on during all of these accounts, or in these accounts, has increased by almost exactly the same amount. They differ only to the decimal point as far as trading in the accounts. So Schwab has some growth drivers in its traditional brokerage. And when I first started researching Schwab, that's all I thought it was a traditional brokerage house that helped you buy and sell stocks, open broker accounts, and do the things that a normal brokerage would do. But I was pleasantly surprised that Schwab did a heck of a lot more. If you'd hit the next slide, Mark. You can see some of the things that it does, but one of the statistics that really sealed the idea that Schwab is growing gangbusters was the statistic which talked about TOA, or transfer of accounts. And it's one thing to grow your accounts, but it's another thing to grow the money that you're transferring in with accounts coming from other competitors, coming from the people that you are competing directly against. When you read this graph on the right-hand side, you want to look at the numbers right above the little squares, the little reddish colored squares. And when you see that 2.0 for the year 2018, what that means is that they've transferred in twice as many accounts as they've transferred out to their competitors. So Schwab is a place where people from other brokerage houses are coming to twice as quickly as they're leaving. And people transfer accounts for all different reasons. But again, here's a real great growth driver for this particular company. Next slide. Schwab is one of the largest movers and managers of retail money in the world. They have somewhere around $45 trillion in retail assets that are being managed, and that's their 2017 number, and I read that incorrectly. That's the total in the world, 45 trillion. Schwab is managing 3.4 trillion of that, and it's growing at 11% compounded. That's about a 7% market share. So even at $3.4 trillion in assets being managed in 2017, they're still only dealing with about 7% of the worldwide market, another growth driver for this company. They are also one of the largest banks in the United States. And what that means is that if you look at Schwab's SSG material on our own tools from Better Investing, you're going to find out that the tool treats Schwab as if it is a bank. About half of the company is an extremely large bank. So some of those numbers that drive the bank's numbers are going to be reported in the same way for this brokerage house, and in fact for some of the other major brokerage houses that I hope you would study in conjunction with Schwab. I'd like to see you studying Raymond James Financial and TD Ameritrade as two great competitors to this particular company, because I think all three of them make an intriguing industry study, and all three of them have great things to warrant their purchase going forward. Next slide, Mark. Here's what I mean by those bank kinds of measurements that we can put on the SSG. The only kind of company where I can draw this aqua line, which represents total assets, are banks and insurance companies. I don't have the option to draw a total assets line on any other company. And I would like to see that total assets line growing at about the same rate as the traditional sales line and the traditional earnings line. I'm seeing that happen. That's extremely pleasing to my point of view. When they're all moving in a relative parallel direction, and in the upward direction, then I'm seeing things operating ideally. And that's what Schwab looks like right now. Next slide. This are some snippets from some various tools. This was done back at Bink around May 16th, so it's a little bit old. So I would urge you to pull up very, very current trading numbers tonight. But around May 16th, Manifest was showing a par value of just under 15%. With a quality of 84. Remember that the Manifest investing numbers come from consensus values gathered from analyst materials, and a large number of analyst materials are consulted to get this consensus number, which is then used to evaluate a par, just like the par we do on our SSG. Most of you would recognize the bottom left-hand corner as coming from a value line, and I'm looking at double-digit growth at the low end or the high end for this company. I like to read that as a range, so I like to think to myself, well, Value Line thinks that this will grow somewhere between 12 and 24% annualized for the next 3 to 5 years. And I'm looking also at the capital market slide, which comes from Manifest, and I'm looking at the two competitors that I talked about. TD Ameritrade is AMTD, RJF is Raymond James Financial, GS is Goldman Sachs. So those top three are certainly all of a high quality, and certainly all giving you pars that, to my mind, 14, 15, 16, they're probably the same number when you take out the tolerances that we use when we do an SSG. So I think it's certainly a great industry study to deal with. I know that Nick Strategos just last month at our roundtable in March suggested that we put a holding into TD Ameritrade, and the audience agreed with him. So I'm back to Schwab again. This is my second Schwab presentation. I did it back in December and then at the convention again. So I'm suggesting one more entry into Schwab. One more slide, I think, Mark. There we go. If I'm going to use an average high PE of around 24 and an average low PE of around 14, and if I'm going to suggest 9% sales growth and earnings growth, then my SSG, and again, this is dated about a week and a half ago, so I urge you to do your own. My SSG suggests that I could make somewhere between, slightly under 12 to slightly under 17%. On this particular large company. I expect a large company to grow about 7% or even less. And if I can get a return of around 12, 13, 14% out of a very large company, then I think that I'm hitting on all cylinders. I get the stability of the large company, and I'm getting a return more akin to a medium or maybe even a small company in the bargain. So I'm suggesting another holding of Schwab in our portfolio, Mark.
Okay, we'll go ahead and ring another $1,000 into the Schwab pot and see how it goes. Anytime we talk about Schwab, at these sessions, it takes me back almost 20 years to communications and working with, Charles himself briefly, but his wife. His wife is actually in an investment club back in those days, and Schwab is actually very committed to education in investing and helping people be better informed and educated investors, and that's certainly a mission we can all endorse and embrace. So thanks, Ken. That's another good one to throw at the mill. All right, what I think I will do here for the next few minutes is, again, I want to spend just a little bit of time talking about where an idea might come from. These are some screening results. I know the slide's a little bit busy, and I'll dig into it, but I'm hoping to find perhaps even a new idea, and I think we do have one to look at here. So what I did is I started out, the screening criteria is all at the bottom. These are actually fairly stringent. I went for only excellent quality companies according to our manifest investing ranking system. And so I wanted just companies that qualified as excellent, 80 or above. I also wanted them to be very good capital allocators and have a robust potential return on invested capital. And that invested capital includes debt and stock. And that's the column you see here in the middle that's color-coded in green. So again, we're looking for superior companies that have a good position with respect to all their capital deployed. Also looking for companies that have a pretty good outlook for the next year. It's something we've done with the Fav 5 on a weekly basis for a few years now. So I wanted to find companies that were fairly close to their 52-week lows. That's the column that you see here, this 52-week position. It's inspired by Hugh McManus. And again, we wanted to find them under 50%, but truthfully, Hugh only starts looking at them when they're below 20, and he loves to find them down in single digits. In other words, companies that are trading relatively close to their 52-week low. In Hugh's view of the planet and the investing world, that's real risk management. You're basically talking about buying companies and noticing the fact that it's natural for a company to have a fairly wide range year in and year out between its high and its low price. Why not try to buy the better companies, the excellent companies that we discover in our studies when they're trading closer to their 52-week low? Walter Schloss did it all the time. We talk about Walter quite a bit. So did Ken Janke. They all saw that as, and I would consider it to be true, risk management in every sense of the word, of trying to capture these companies when, again, they're down fairly close to their 52-week low.
Mark, can I interrupt for just a second?
Absolutely.
On the ROC column, we're getting some issues. Is this the same as return on equity that we measure on the stock selection guide?
It's not. It's actually return on total capital, but it's different than anything you've looked at yet. It's something we're going to cover as a independent subject. In a nutshell, it's going to basically come down to how people like Warren Buffett look at the realm of investing. So
let me follow up a question, Mark. If a company had no debt, would return on capital equal return on equity?
Not exactly, because we're basically looking at average returns over the next 10-year time horizon. So no, it's not quite the same as anything that we look at yet.
Okay, and one last question. If somebody really was interested, could you, if they were to email you, could you show them how or give them a calculation so they might be able to calculate this number themselves?
I'll do better than that. I'm going to show why we're looking at it, and there will be a webcast dedicated completely to the subject in the near future.
Excellent. Okay, that answers the questions we've had so far.
Yeah, it's a powerful subject because it's something that I'm becoming more fond of every day as we put it through its paces and try to figure it out. So I think it's going to prove to be very interesting and very faithful to the types of things that we know are important based on the teachings of the modern investment club movement. So I wanted to limit the field again to companies that are priced attractively also. Value Line's low total return forecast, the average is 6.2%. Wanted to find companies that were above that. There was no shortage of those. Quite a few companies that fall into this screen that have a double-digit return forecasts. The Morningstar price to fair value, the average value at the time that I did the sort was 95. And again, you can see a fairly robust sampling of companies that are, again, as Kim demonstrated briefly with Air Lease, trading at a discount to their fair value. That's the way most of Wall Street takes a look at the attractiveness of companies. The analyst consensus estimate of that same characteristic along with S&P at roughly a little bit more than 100%, you can see that we have a fairly good cross-section of companies that meet that criteria also. And these last two columns are simply, we don't care about them quite so much, but I do like to find companies that are positioned well for the long term, but still have a lot of tailwind for the next 52 weeks, the next 1 year going forward. It's just kind of like a tiebreaker for me sometimes. If I can find that, particularly in combination with some of Hugh McManus's close to a 52-week low. We could be onto something here. So the company I'm actually going to go with is this Regeneron Pharmaceutical. A good, excellent quality company. Again, trading fairly close to its 52-week low with double-digit return forecasts from Value Line, and all of the characteristics, according to the analysts who follow it, suggest that it's potentially on sale, and it has a pretty decent one-year outlook, also, so suggesting some perhaps temporary undervaluation. All right, here's what they look like on visual analysis of their business models. I know it's giving everybody out there a headache. That's all 16 of them. Taking a look at page 1, taking a look at up, straight, and parallel for all 16. And again, I don't see anything that jumps off the page. There's a couple of them that give me a little bit of heartburn. There's a little flatness on this one, a little bit of bumpiness down here, not so bad. But in general, I think most of those all qualify for up, straight, and parallel. And it's the type of thing that as you're thumbing through these companies, you're looking for these type of companies. So they passed all of those screening criteria. They also passed this visual. This one's a little bit ugly. It's got a little bit of a bump in the earnings, but seems to be recovering. But I think you get the idea. Some of these just show a little bit of weakness with some recovery, but all look pretty good to me. Here's what they look like on Chronicles. The Chronicle at Manifest Investing is nothing more than the stock price, the quality, and the return forecast all plotted on a monthly basis for, in most cases, a 4-year trailing period. So what you're looking at is all 16 of these companies, and we like to pay a lot of attention to, again, that top line in blue, that's the quality line. The red line is the return forecast line, and again, the green are the price bars. So again, just kind of looking down this chart, I see one here. This happens to be Coach. I like it for its turnaround characteristics, but I don't need those quality issues right now. Some of the others are a little bit bumpier than I would like. We know that these are all potentially undervalued, but what we tend to try to look for is, just like is shown up here in the upper left, is a company that has either a flat or up quality trend characteristic or trend. Quality EKG, if you want to think of it that way. We want it to be strong and up there. And then what we are looking at as kind of the final stack in the deck, last domino to fall, is a return forecast that's relatively high compared to what we've seen for the last few years. And so we're looking for the red line in each one of these to be at or near multi-year highs. So we see that condition with Walgreen. That's all Walgreen Boots Alliance. You've got a return forecast that is at a multi-year high. That's one of the reasons I selected it for the Let's Talk Stocks panel discussion in Chicago. We also see FedEx. FedEx had a magical moment back in December. I wish I'd have noticed at the time, because I would have accumulated shares of FedEx when its return spiked up so much back when everything was pretty ugly, very ugly. Another company that has really decent return forecast characteristics right now is Cy Lynch's 26, IIVI for the ticker symbol. That's the one he presented at the roundtable in Chicago and has talked about it a few times here at the roundtable in recent months. And last but not least is the company I did decide to go with is Regeneron Pharmaceutical, because I see a quality trend that's improving. And again, a near multi-year high when it comes to the PAR or the return forecast. So I probably won't put 16 of these together on a page. I just wanted to make the point that very quickly, your eye can be drawn to things that you know are important. You know, steady or improving quality in conjunction with a multi-year relative high when it comes to the return forecast. Again, think a strong or elevated Section 5 return forecast result on your stock selection guides. And we'll take it from there. By the way, British American Tobacco made it on my short list also for the panel discussion. So let's talk about this Regeneron Pharmaceuticals. Pretty much up, straight, and parallel. The things that draw my attention to this company are a few. We're talking about a company with a growth rate in the high single digits, call it 9 or 10%. That's as typified by the visual analysis and the trend that you see there. The other thing that kind of jumps off the page at me First is this relative mesa or a flat spot in the price over the last several years. We're talking, in this case, a flat spot of 4 years or so, during a period when the fundamentals, as measured by the sales and the earnings, are actually improving. Now, there's a little bit of a flat spot here. We just take note of that. That if price follows earnings, it certainly is doing that a little bit in this case.
Mark, that might also be that it's doing some consolidation in the stock price before it moves up.
Yeah, definitely. I mean, they hit a pretty good high a couple of years ago, and that you basically do have a bit of a trading range for the last couple of years. But again, on a stock selection guide, you're talking about an improving fundamental situation throughout. So pretty fascinating. The comparison again to the end of the year until now, the price is actually down $50 from the end of the year. But the analysts who follow the company actually see projected margins going up into the mid-30s. The PEs are the same, so that's the big change. That's the big change that you're looking at from one point to another. And we are talking about, under these assumptions, 9% growth, 35% profit margins, and a PE ratio in the 30 range. Seems pretty reasonable based on what we're seeing here. All this seems pretty reasonable to me. Look at the profitability. We're talking about a company that could be in the mid-20s, as high as the mid-20s for the return forecast. So that's what we're looking at. So how did they get there from here? Here's that longer-term look on the month-to-month picture on Regeneron, courtesy of stockcharts.com. Again, here's some of that consolidation Kim was talking about. They had a heck of a run since their more popular drug we'll talk about in a minute has done very well for them. And we're waiting for the next, for the curtain to come up on the next part of the play. Well, here's the one that's really kind of holding everything down. This is the foundation. Think of it as the foundation. This Eylea drug, it's actually an injection that is given to patients who need it that have macular degeneration. They're actually using it now for diabetic eye challenges also. This accounts for about 80% of their sales. You can see how steady that situation has been for the last several years. Physician acceptance has been quite strong. This is an area that the analysts who follow the company, the rhinos, tend to worry about for the company. They want more clarity or vision on what the future might hold. And all the company can say is, hey, we're basically just getting started. We have very rapid acceptance. It's very effective in the patients that are treated with this. And again, just this notion of the acceptance being so strong. And then they point to the demographics and the diabetic profile, that's facing all of us. And they don't see anything slowing down. They have patent protection for the next 5 years. Obviously, there will be ramifications 5 years out. That's part of what is being accounted for. But it is a solid foundation that is really contributing a lot to the bottom line. They do expect the annual sales to reach the $8 billion figure in the next few years. You can see they're at 4 right now. So this is kind of the rock that the whole place is built on. They have 4 major drugs. You can see them outlined up at the top, or treatments: Dupixent, Libtayo, and Praluent. Let's take a look at what they're doing with these. This is a really busy slide. I apologize for that. I mean, I listened to people from the company that could talk off of this slide for 2 hours, I swear. But what it comes down to is they have a very successful product out now in dealing with dermatitis, this atopic dermatitis that you see the picture on the far right of the individual with a pretty bad rash outbreak on their upper back, and after the treatment, things got much better. In addition to treating this type of skin affliction, and that sort of thing, they actually are now branching out into treating asthma with the same medication, and focusing on adolescents. So you can see that it's being accepted. They tend to be branching out, and there's a whole lot of hope for this sort of thing. The Libtayo is the one that has come out in the last few months. It's for skin cancer. CSCC stands for whatever that says right up above it. Kim can pronounce that for me. She says that's just a long way of saying skin cancer. And they've had
atopic dermatitis in adolescents. Oh, advanced squamous cell carcinoma.
Mm-hmm. Bad stuff. That's what the picture over here on the right is of a gentleman that has a skin cancer site right behind his ear. And they've had very powerful results with treating that sort of thing. And I learned a new phrase that I don't think I've ever heard Hugh McManus use. It's been given breakthrough therapy designation, which is meant to expedite any of the approval processes for treating various classes of potential clients. And it's the type of thing where they're seeing a lot of work crossing over into other areas, and their pipeline is absolutely chock full of efforts in things like dealing with allergies. We have grandsons that actually have these darn peanut allergies. I know how serious that is, and they're looking at that. It's not shown on this slide, but they're also working with COPD. You all know people that either have forms of cancer or these type of afflictions, and these guys are working on a lot of wonderful areas and showing some very promising test results. And we hope to see more fairly soon. So again, I'm not a doctor. I don't do this stuff on a day-to-day basis, but what I do see them doing is working in some key areas that affect the lives of people around me. They are working with fairly powerful partners like Sanofi. We've done work on Sanofi here at the round table in the past. This one's coming along. It's got that preferred expedited status. And again, I almost frame this in terms of thinking about Amgen 20 to 30 years ago. There was another company, Aguron Pharmaceutical, that was working in some of these areas 20 or 30 years ago. Many investment clubs followed it. And I do like to watch for companies that are showing promise in oncology. I have many friends and family that have challenges in that area, that anything that can be brought to make their lives better is certainly a very welcome thing. So the analyst who follows this company basically says that they're taking the successes that they've had in a few areas. They have that foundation from the eye treatment drug, which is very, very well leveraged and in place and providing some very necessary cash flow. And again, the value line closing paragraph kind of makes the point. There's a lot to like here. Potentially well-diversified stream. There's always risks with FDA pipelines. I would love to have Hugh McManus critique where he sees the company in some of these pipeline areas. Maybe we'll get him to do that in a future month. But they see a lot of potential for this company, and it's got a lot of appeal. So I'm going to go ahead and double down on my selection of Regeneron, and I think it's the type of company that offers exciting potential growth and certainly worth a little bit of speculation in the roundtable tracking portfolio. So with that, Ken, I think we can release it for the audience to make the 500th decision by the roundtable since we started doing this.
And the poll is up. All you have to do if you're on a laptop is take your mouse or your finger and choose which stock you'd like to have.
I forgot to mention the part about only getting 2 hands in the air. I'll wait till everybody's done voting.
All right.
I do believe your presentation tonight took all the extra time, Mark, and all your persuasive speech. So hopefully tonight you're the winner.
Well, we'll see.
I'm going to count to 10 in my mind and try to get us there. We went over 82% voting. So how about 3 or 4 more of you hitting the vote button, and we're going to close the tally right here. And let's display the results. And Mark, you ran away with it, okay?
Oh, wow. Wait, mark the calendar.
This is a momentous day for many reasons, Mark, okay? So The 500th
deserve to have
choice will be Regeneron in the portfolio. And let's hide those results. And you can go to the next slide then, Mark.
Well, let me finish the story because we made this presentation to about 80 people in person, face to face, in Chicago, and 2 hands went up after the voting for the companies, and we only had one other one, that 2-6. So I was feeling kind of despondent about it. Turns out the 2 hands that went up were retired pharmacists that they said you need to tell that story a little bit better, a little bit stronger. And I did a little bit better, not a lot better, but I really do think that those type of companies are really potentially rewarding for us in doing this kind of stuff. All right, Ken, you want to go ahead and let people know where we're going to be?
Well, folks, you can read, so I'm not going to read this for you, except to say that this coming Saturday, we're going to be in beautiful Traverse City. If you're in the Mid-Michigan chapter or the Capital Area chapter or the Southeastern Michigan chapter and happen to be traveling up north, join us on Saturday morning up at the Traverse City Elk Club. We'll be up there from around 9 o'clock in the morning till around noon or so, and we'd be glad to have you as we talk with one of our model clubs up there, the Porta Value Model Investment Club. We'll have some of our other members from the far north, and we'll be running just a real nice informal session with lots of Q&A, and they're real good people, real fun to be around, and we should have ourselves one interesting morning up there in Traverse City. We have some hands in the air, so I'm going to, well, here's one of our Traverse City directors has his hand in the air. So Herb, you're unmuted, go ahead.
Yeah, Ken, that's going to be at 10 o'clock. I'm going to get you in the building about 9:30. So we won't get started until about 10 o'clock.
Okay, so folks, 10 o'clock if you're in the Traverse City area, and we'll probably go to maybe, what, Herb, 12:30, 1 o'clock, something like that then?
Yep, and then if those want to eat, have lunch there at the Elks Club, we can eat lunch.
Great, terrific, okay. I have a couple of questions. Let's see what we have. Shirley wants to know if this whole thing is recorded. Shirley, it absolutely is recorded. The recording will be posted tomorrow on YouTube. If you're looking for it, go to do a search for Manifest Investing Roundtable, and that should take you to our channel, and then you can subscribe to that channel. That way you'll be able to get back there real quickly. We probably have more than 5 years of different roundtables on there for you to listen to, and we're happy to say that they get hits from more than just me and my wife and Mark's wife, so it's very nice. Okay. I don't see any more questions coming up.
Just one editorial comment about content. Ken and I have not actually selected a formal topic for the Turnout Tuesday, next Tuesday night. I'm going to throw just small company investing in there probably. We might even be talking a little bit about that return on capital stuff, but if you have a topic that you want us to cover, please let us know, and we'll certainly have that as one of the 2 or 3 segments if we can wrap our arms around it and share some informative thoughts about it.
And then, Mark, I have John worried about Skyworks, so he's anticipated where we're going with our final question here. So, John, Mark has even prepared some slides for you for Skyworks. So let's talk a little bit about Skyworks. This question came to us in an email, and Mark shared the gist of the question, and then we're going to try to do a twofer and give you an answer for it. Go on, Mark.
Yeah, so this came from J.R. Greer in Chicago, and just looking for some commentary on this. And this has really nudged Ken and I. We were talking prior to the opening up the green room tonight about this whole notion of better selling and how it's been a little bit controversial with the rule of 5 and the 20% drop in the timeout. I'm not going to go too deep into it other than to say it's causing us to rethink it a little bit. We think that we were kind of forced into a void, and just let me back up and say when we started with the rule of 5 and this notion of a timeout, it was one primarily designed to watch for just missing the boat on a stock in the first 12 to 18 months, and that was the way I always framed it. Not, in other words, not thinking about a company, 5 to 7 years out, and applying this rule of 20, the rule of 5, this 20% rule on relative performance. So it doesn't really apply so much. The starting point for the 20% drop is, and we'll show you a graphic here in a second, is to basically compare the performance of the decision or the selection you've made versus a stock market benchmark going forward, again, for that first 12 to 18 month period. And when you see one that's completely falling apart, just knowing enough to call a timeout and walk away, you can always come back to it. And so we're going to take a look at this one. This is one where the club bought it in, as they said, January 2014. It soared. And then it basically hit one of those plateaus as shown on the value line chart there. Here's a look at it on the Chronicle. You can see that Ken also picked it, and the audience seconded his motion back in September 2015. And it's languished a little bit since then. It's not exactly set the world on fire, but one of the things I think Ken was alluding to earlier is this notion of, we talked about Qualcomm and some of those other companies with slightly deteriorating quality. I think Skyworks falls into that also. It's not a price-related issue for possibly selling so much as, is that quality degradation taking place? And basically what you see is probably some competitive pressure and reduction in margins. You probably see some financial strength weakening, not a lot, but again, stacking it up against some of those other companies, you really have to take a look at, what is your outlook for Skyworks going forward? Anything you want to add to that, Ken?
Yeah, we also talked at length when we were developing this trigger, and this idea of 12 to 18 months was central to a stock we had basically just purchased or had made a relatively new purchase on. But we also talked about the fact that we weren't going to be as concerned about a company where the whole industry was languishing behind the market as we were about a single company within an industry languishing when other companies were doing just fine versus the market. I think if we were to do a graph of the semiconductor ETF, the ETF that tracks the semiconductor industry against the total market, we'd find that this relative return of greater than negative 20%, I think we would find that it was there for that whole ETF, for that whole industry. It's not just Skyworks that's lagging the market. It's a lot of the semiconductor stocks that are lagging the market. I happen to own Skyworks in 2 of the clubs that I belong to, and we're facing the same issue, John, that you're facing, and that's do we think we have a good quality company based on what is happening with the whole semiconductor industry, or do you think that there's a better one to take a look at within the industry? And of course, that whole discussion is predicated on, do we really want a position in this industry to begin with? So it's not as easy as it sounds, but when you've held a stock for as long as you've held the Skyworks stock, I don't think that we're looking at automatic triggers. And Mark and I both want to kind of take a step back and do a deep bow and an apology for in the last 6 or 8 months kind of forgetting our own rule, which was that our 20% trigger was supposed to be used for fairly new holdings. It was never to be used for things that we had in the portfolio for 5 or 6 or more years. So Mark said it, I've said it. We're volunteers, and sometimes we need fact checkers, I think, to keep us on the straight and narrow.
Well, somebody to crack the whip, yeah.
Somebody to crack the whip, yeah. But I honestly think that Skyworks is a company that your club can spend some time discussing, and those issues that I raised are the issues that we're discussing in the clubs I belong to, and those issues are Is Skyworks representative of what is happening to the whole industry? Is Skyworks near the top of the industry or not? And do we even want to have a presence in this particular industry, considering how cyclical it is and how poorly it's comparing to the market as a whole?
Yeah, and I would second that. I think they are formidable. I do think that an audit is in order. I mean, they are leveraged into 5G. They have great clients. They're all over the Internet of Things, so they're part of this. I mean, if you're looking to own, a part of that concept long term, these guys are very much a potential player going forward. And you're going to have to decide, how well positioned are they? One of the points that I wanted to make tonight, as we kind of close this discussion down, and we'll be coming back to this, is take a look at what is going on in the industry. I don't think this chart really makes a lot of sense in the big term, long term scheme of things. The fact that it lagged the market by 20%, a few years out, that doesn't mean a whole lot to me at this point. I mean, the picture that you're looking at here shows the situation as it's been. And I think Ken's right. You overlay the ETF for semiconductors, and you'll find that it's not behaving terribly unusually in the industry. And the final point that I want to make, well, there's actually two. I think we can probably find a simple, powerful notion to track for preserving capital gains. I mean, the club, bought back in here, and this is where some of the angst is coming from JR, because they have this tremendous gain that they've got that has languished, and they want to make sure that they don't give all this back. I mean, that we've all done that at some point in our careers. We want to find ways to avoid that. If we could find something simple, powerful, and similar in concept to a trailing stop for this type of situation, that's the type of thing you're going to see us try to come up with for this particular situation. And the final point I want to make is companies like Skyworks, in the fairly early stages of their development, they all go through the moments and speed bumps, however you want to think of it. Even Amazon, a few years in, had you can barely see it on this chart, but you would have been stopped out. A 20% limit would have taken you out of Amazon back then, basically surrendering some 30,000% gain. And we certainly don't want to support that. We want to find situations where, we avoid taking that type of action on a company like Amazon, or many others that I could actually bring up. These type of challenges are just natural life cycle challenges for a company along the way. And again, if you walked away from Amazon at that point in time, you may have never gotten back in. It's not just companies like Amazon. Here's a picture of Nike, very long-term chart. And what I want to draw your attention to is go way back here to when they obviously had some profit challenges. You see them here, you see them here. It happened again back around that 1998 time frame. So again, David Gardner is famous for holding Netflix and Amazon and companies like that through these type of challenges. Again, if he believes that the company truly is a leader and is well positioned, in the competitive environment. So again, I would urge the club to sit down and think about, what are the realistic growth expectations? What's the profitability look like? They mentioned increased competitiveness. Does that increased competition mean that those net margins are headed south and going down? If so, what does that do to your stock study and your expectations for the return forecast? What do these numbers look like in that competitive environment? And again, the decision to be made, is this company truly, a leader in its field, well positioned for 5G, well positioned for the Internet of Things, great customers, and everything else that we know is important in tracking the companies that we know and study. So that would be my long-winded answer to the question, and it really is just the tip of an iceberg that I think we're going to be covering in much more detail.
Mark, I missed a question from Ione back during your presentation. Can you speak to the chronicle for Urban Outfitters? It was one of the stocks in your 16 that you presented, and she noticed that it had a particularly low par. Could you speak to what the chronicle is telling us, if anything, about Urban Outfitters?
Okay, I can go back and find it, and then we can actually go look at it. Let's see, Urban Outfitters is, oh, right here. Well, it's not exactly a low par, but let's go ahead and take a look. I'll jump out and actually head to, it's always dangerous when you go live, right? But again, this will give you a live look at Urban Outfitters. I'm going to simplify the chart. So what Ione is asking about is a relatively low par. I would say that the par is pretty much quote unquote normal or fairly close to average. As Ken mentioned earlier tonight, the return forecast, the projected annual return on the average or median stock is right around 9 or 10%, and you can see that that is that actually Urban Outfitters is at 13.6, so they actually have a fairly beefy return forecast at this point in time. They went through some challenges in the retail environment. Again, think about some of the stuff we were just talking about with Skyworks. These guys are in an intensely competitive industry from time to time, and they seem to have, at least once again, weathered the storms. So
now we should make it clear, Mark, that when you're hovering at the end of these lines, we're at the very end of a month. So you're looking at not a May number, you're looking at an end of April par number when you hover at the end of the graphs.
Right. And so the current situation is 14.5. So that's certainly not low. That's a weak buy for most people. I don't know if that took care of her question, and she'll follow up if she's got more on that.
Okay. Mark said at Bank, this is from Jane. Mark said at Bank that he'll talk about Cognizant Tech, about what's going on with them. Can we promise, Mark, that we will bring Cognizant Tech into our discussions at our turnout session next week?
Yeah, we could do that because the subject came up in terms of, is it weakening? And in fact, you indirectly touched on it in talking about EPAM. You know, are there alternatives to Cognizant? And Cognizant is so widely followed, so widely held by people in the community. So here's the question, and it's one that we could tackle in much greater detail. I mean, it seems to be hanging in there okay, but we are seeing some margin erosion. And, you know, is this a situation where this price plateau that you see is suggesting something? You know, maybe their vulnerability to the potential global recession. Anyhow, we could talk about this in much greater detail. I think we should.
I think what will be interesting, Mark, is that we'll have one more dot on this graph next Tuesday. We'll have the graph dot from the last trading day in May. And that should be interesting to see what happens at that particular point then.
Yep.
Mark, Nick would like to know, where did that Skyworks chart come from? Did you find that somewhere, or did you create that yourself?
Can he give clarity as to which one? The Skyworks.
Nick, which one are you talking about? You're going to have to tell us. And meanwhile, David would like to know, can you define quality? And Mark, why don't you just give David the reference that we give for people that are looking for a good, solid definition of quality?
Yeah, the basic instructions that we think are a good idea is go to Google. We do that for everything now, right? And do manifest investing in the word excellence, not quality. Excellence. That'll take you to this article, which is Excellence Measured, and that'll take you to basically the origins. You know, it's based on Benjamin Graham and George Nicholson, and it'll give you the blow by blow. There you can see a graphic, but it actually defines it for you and tells you how we use it and how we calculate it.
And then Mark, Nick is looking at slide 38.
Slide 38. Okay, yeah, that's simply Finance Yahoo. All that is taking Finance Yahoo. Let me blow this up. Going to Finance Yahoo, entering, well, obviously Skyworks, but the actual purchase date, which in the case of the club in Chicago was December 2014, and through the present, and basically graphing so you can see that wonderful run that they had, outdistancing the market by a huge amount. This is the Wilshire 5000, this red line, and you can see that they actually outpaced it by quite a bit, but look how much they gave back. And they don't want to give any more back.
I think you typed the Wilshire 5000 in there under that comparison. I'm up there in the upper left-hand corner, didn't you, Mark?
Yeah, under comparison, I just used the VTSMX. That's the Vanguard Total Stock Market Index. That's the Wilshire 5000. So you've got a percentage side-by-side comparison for, and you're looking for the point where the blue line would dip this much. This arrow is a 20% arrow. You know, would it fall behind? And again, let's reinforce that, as Ken and I were mentioning, that really was only intended to provide that protective measure in the first 12 to 18 months from the time of purchase. After that, something else has to kick in. That's what we have to, beyond par, beyond the projected annual return and the quality, there's a third dimension that we have to quantify a little bit better to protect capital gains.
Well, Mark, I'm going to say the magic words. I don't see any hands in the air. I don't have any questions left on the questions box. I've either answered them myself through typing or we've answered them live. So with all that, I usually kind of count to 4 in my head to make sure nobody is trying to shove something in last moment, and they've stayed empty. So I want to thank you, Kim. I want to give a big thank you to you for stepping in the way you do. We really appreciate it when our normal folks, when Cy and you can't join us. I'm just babbling, okay? So.
Well,
Thanks
thank
a
you.
lot.
I'm the unnormal one.
Thanks a lot for being with us, Kim and Mark. As always, thank you for all you do. I'm going to say goodbye to everybody, and we'll see you. Turnout Tuesday is next Tuesday, and the next roundtable will be the last Tuesday in June. Thanks, everybody.
Thanks, guys.
Night, guys.